Hi, my name's Rhett Kessler. I'm the portfolio manager for the Pengana Australian Equities Fund, and the purpose of this video is to provide an update as at the end of October 2019. So I'm going to break it up into several components. The first bit is the backdrop. It's very interesting. The first overriding aspect, I would say, that investing when the cost of money is extremely low has been interesting and in some cases challenging. People do strange things when the cost of money gets this low, and on a global basis we've got a chart going back 300 years for the global cost of money, which is the US 10-year bond yield, and it's never been lower. So you're starting to see some distortions of how people are pricing, and particularly in monetary policy, that are unusual. The second factor, which is creating a lot of noise, is the on-off trade war that we've seen. Whether it's a tweet coming out from Donald Trump, the President of the United States, or it's commentary from the Chinese authorities, the markets have fluctuated from optimism to pessimism, and this has created a lot of noise. As always, we try to focus on the underlying fundamentals, and we've been finding fertile ground in focusing on the underlying fundamentals of companies that make what we call toilet paper and toothpaste type products or services. In addition to people doing crazy things, certain share prices of our favorite stocks have done exceptionally well. And our old favorites of CSL, Credit Corp, ResMed, and with a little bit of volatility, Super Retail, have really shot the lights out in the last month and longer. So as many of you know, we've had these companies for many years, over a decade in most cases, and they've done exceptionally well. Valuations are getting full, and during the month we trimmed some of them quite substantially, but have been taking some profits. On the flip side, something else that's occurred with worrying regularity is the volatility that we've seen in various share prices. So we have successfully been on the right side of trades where share prices have fluctuated 10 to 15% within a month, and in some cases, particularly Super Retail, within a 3-day period. So we have a valuation of what we think the company's worth. Some news comes out, we test that news against our investment thesis, and as is the case with Super Retail, the stock fell 10-15%. We bought substantial amounts of stock, and 3 days later the market decided that maybe they got it wrong, and it had bounced up 10 to 15%. This has occurred with occurred regularly with several of our core holdings: Credit Corp, ResMed, Accent One, NIB, Medibank, Super Retail. And it's a flag to us that conviction is not that strong, and that there's a lot of hot money flowing through the market. One of the companies I'd like to address in this update is Aristocrat. We have bought a substantial holding. It's now in our top 10, and it's a very recent acquisition. It was the opportunity to buy it was created when the market got quite nervous about its digital business, and the company was sold off by 25 to 40%. We remain very focused on its core business, which is a land-based, globally diversified gaming machine sales and participation business. They dominate in that area. The barriers to entry are enormous. There are only 3 real oligopolies globally. The lead time to sell a machine is enormous because you have to get regulatory approval for both the system and then the individual machine in every single jurisdiction you seek to sell it in. Aristocrat has over almost 200 jurisdictions that they're approved in now, and similarly a multitude of products. When the product works, let's say in Las Vegas or in New South Wales, you know that as they roll it out across other jurisdictions for the next 4 to 5 years, you've got a very good visibility on a tail. So they have a multitude of really well-performing products that have only started that rollout journey. The sale happened around the digital side of the business. And the share price got sold down to a level where we think we got the digital business for free. Results have just recently come out, and the digital business is actually traveling quite well. But our real focus is the land-based business. For you get 80 cents in every dollar is for the land-based business. And so we're very comfortable with that position. It's about a 5% holding in our portfolio. After-tax cash earnings yield is still close to 6%. We think it grows to north of 10% easily within 5 years. In summary, the portfolio we think is exceptionally well positioned at the moment. It has a number of global businesses which give us really good currency diversification. The portfolio is filled with toilet paper and toothpaste type businesses where we don't have to worry about the economic cycle. We have no commodities. And I guess finally, where we do have some discretionary retail, as in super retail, JB Hi-Fi and Accent One, they're being priced as though the economy is not going to recover. And so if the economy does recover from these levels, we think we'll get a nice bonus. And so after a year where we've recovered exceptionally well from our lows of last year, we think the portfolio is very well placed together with our put protection to succeed in achieving our dual goals of capital preservation and delivering that risk-free rate +6. Thank you.